have you looked at bond valuations, right? We have looked at stock valuations, right? So now we'll look at some of the derivative securities, um, and then we'll start by defining what derivative securities are. Okay, so this is the plan. It's very kind of simple and straightforward, right? So we'll cover three different types of derivative contracts in today's session. So we'll look at forward contracts, we'll look at futures, and we will look at options. Right, okay, so what is a derivative security? So what does derivative mean, right? Something whose value is derived or based on something else. Right? So when we talk about financial markets, then financial markets, a derivative is a financial contract that derives its value on an underlying asset. So that underlying asset could be a financial asset or it could be a real asset. Right? So the value of derivative is essentially based on the value of the underlying asset. As the value, which essentially means if the value of the underlying asset moves, so will the value of the derivative, right? Okay, good. So what are the key characteristics of derivatives? So it's based on at least one underlying asset. Okay, so that underlying asset could be anything. Could be any asset, a financial asset or a real asset, right? So it could be a stock, for example, or a bond, or it could be any precious metal, right? It could be other commodities like oil or wheat or orange juice, right? It could be any asset. Okay, good. So for a derivative, in order to have a derivative instrument or derivative security, you need to have at least one underlying security. It could be based on a portfolio as well. Derivative could be for a portfolio as well. And what is a portfolio? Combination of different assets, right? Okay. So another key characteristic of derivative securities is that there is no transfer of ownership of the underlying asset at the time of the contract. So when you enter into a derivative financial contract, there is no transfer of ownership, right? Because transfer of ownership might take place at a future date, right? And it will depend upon the type of the derivative security as well. What type of derivative contract or what type of derivative instrument you're using. Okay, so there's no transfer of ownership of the underlying asset at the time of the contract. It's a promise to transfer ownership of the underlying asset at a specified price, place, and time. All of these are determined in the contract at the time you enter into a derivative security contract, right? So price is predetermined, place, I mean where the transaction will take place, or where the delivery of the underlying asset will take place. That's predetermined, as well as the time, when the transaction will, when the exchange will take place, right? So these are traded, such derivative instruments are traded on stock exchanges as well as over-the-counter market. Okay, good. So why do we need these derivative securities? The basic purpose is for hedging. And what is hedging? It's a way to reduce the risk, right? So far we have talked about, this risk and return principle, right? we know that if we take on more risk, then we expect to earn higher returns. But there is a downside of taking risk as well, that if you do take more risk, then the probability of losses is also higher, right? So these derivative instruments, derivative securities were invented as a way to mitigate or reduce the risk. So that's one of the key purposes of using derivative securities. The financial term that we use for this is hedging. So it's basically a risk management strategy, and then how do we do it? We take an offsetting position in an asset or an investment with the objective to reduce the price risk. Okay, so for example, if an investor has bought an asset, and by buying an asset, we mean that we have taken a long position in that asset, right? If an investor has bought an asset, so she can hedge by contracting to sell the asset at some future date, right? So if you have bought an asset, which means you have taken a long position in that asset, right? So you're exposed to the risk. You're exposed to price risk. So the price of that asset can go up or it can go down, right? So you're exposed to price risk. One way to reduce such price risk is to sell it forward. Determine the price at which you're going to sell it at some point in time in future. So you'll enter into that contract today and agree to sell that at a specific price at some point in future. So most financial managers use derivatives with the objective to hedge, to reduce the risk or manage the risk. So that's the main objective of most financial managers. But there are other individuals, other people who can use it for speculation as well. And the end result in both cases is the same, right? The payoffs would be similar if you enter into a derivative contract or derivative securities contract, right? But the objectives could be different. One party might be entering into the contract with the objective to minimize risk. The other party might be entering into the similar or same contract with the objective to make some money, right? So that's what we call speculators. So they use derivatives with the intent to generate some sort of positive returns, right? Okay. Good. So let's start by forward contracts. So forward contracts are relatively straightforward. As the name suggests, so you will be entering into a contract that takes place, where the transaction takes place at some point in time in future, right? So it's a contract between two parties that engage in a financial transaction at a future date. Okay. So the contract can be written however the parties want. That's one of the key advantages of a forward contract, because it can be customized. So the two parties who are entering into a forward contract, they can determine the quantity that they want to sell, the price. They can agree on a price, at which the transaction will take place. They can agree on the time, whichever suits them. So these are quite flexible in these respects. So contracts can be written however the parties want. The contract usually include the following pieces of information. So you have to specify the exact asset that will be delivered, including where that asset will be delivered, right? So as I said, that asset could be a real asset, it could be a commodity, or it could be any other financial security, financial asset. So the underlying asset must be mentioned. Okay, what which asset is being considered for transaction, the price that will be paid for the asset is also predetermined in a forward contract, and the date of exchange, when the actual transaction will take place. Okay, so three key features of a forward contract: the underlying asset, the price, and the date when the transaction will take place. Okay, good. So let's take a quick example to understand how a forward contract can benefit both parties. So here we have a wheat farmer and a flour mill owner or flour mill, right? Okay. So if you're a wheat farmer, right? So you are exposed to the price risk because it will take some time, when you sow the seeds, the crop will, grow, and then you'll harvest the crop, right? And then, a price, whatever the price would be at that point in time, you would have to sell it at that market price. So, so, so the wheat farmer needs to, once the crop is ready, he or she needs to sell the wheat. So it will take some time, for the crop to be ready. So the farmer essentially is exposed to this price risk. He needs to know the income that he can generate at the time of harvest, okay, which will depend upon the future price when the crop is ready to be sold. Whatever is the price at that point in time, that will determine, how much income the farmer will generate. So the farmer is exposed to price risk because the price of wheat today, when he's, let's say, planting, or when he's uh, preparing the land for the crop, right? So the price of wheat today might be very different from the price of wheat when the crop is ready. And if you think about it, once the crop is ready, it means the supply goes up, right? So when the supply goes up, prices typically go down, right? Okay, so the farmer is exposed to price risk. So flour mill also need wheat to make flour, right? And that's their product. That's what they sell, right? So for them, the cost of wheat, uh, it's the raw material. Wheat is the raw material. They need to buy wheat. So they need to know the cost of wheat purchase. How much would it cost them to buy wheat? So they are also exposed to this price risk because price of wheat will fluctuate over time, right? Okay, so both the wheat farmer and the flour mill are exposed to this price risk. So both parties can eliminate their risk, right? They can somehow manage or control this price risk by entering into a forward contract, right? So the crop is not there yet, right? Okay, it's not ready. But both parties can reduce their price risk by entering into a forward contract today. Okay, so the details are the quantity of the wheat that needs to be determined, what quantity of wheat will be delivered, the price per unit. So the three things that I mentioned earlier, the exact asset, so which is wheat in this case. The other factor was price, right, which needs to be predetermined. So the price is predetermined, okay, and when the delivery will take place at some point in time in future, which is kind of specified as well when the harvest. So which is typically when the harvest is ready, okay, and then when the crop is ready and you're about to harvest, right? So by entering into this forward contract, both parties can reduce their price risk, okay, and both parties can benefit. And because these are flexible, right? These can be customized, right? So the farmer and the mill and the flour mill can, agree on dates, delivery dates. You know, if the farmer has, uh, uh, it's, let's say a week late, or if he planted the crop a week late, that he might be, harvesting it a week late, so they can agree on the delivery date. Okay, so what are the benefits and drawbacks of such forward contracts? So the key benefit is the flexibility. They can be customized, right? Okay. The downside is that there isn't an active liquid market for such contracts. So liquidity is a big issue, right? And because of illiquidity, there is also there might also be incentives for one of the parties to default. Because if you enter into a forward contract, the gains of one party will be exactly equal to losses of the other party, right? So the party with losses can potentially, they have an incentive to default on their contract, right? So depending on which way the price moves, there may be a strong incentive for one of the parties to default on the contract. And if either party defaults on their agreement, the only way to get compensation is through litigation, which is costly, right? So illiquidity. So part of the reason these contracts are illiquid is because of the benefit that they provide, that they can be customized, right? Okay, good. So let's look at an example of a forward contract. Here we'll use it in the case of where one of the parties try to reduce their exposure to interest rate risk. What is interest rate risk? The interest rate might fluctuate. That the interest rate might fluctuate, and if you have a portfolio of assets whose value depend upon interest rates, right? So the value of that portfolio will change as interest rates change, right? So you'll be exposed to interest rate risk. Okay. Right. Okay. So First National Bank owns $5 million worth of T-bonds that mature in year 2037. So First National Bank is exposed to interest rate risk, right? So if you are a manager in First National Bank, right, and you're managing this portfolio, what would be your concern? What do you think is the risk? If interest rates go up, the value of the T-bonds will go down, right? The value of your portfolio of T-bonds will go down, right? Because there's an inverse relationship between discount rate, which we use here, and interest rate, which we use as a discount rate, right? Or the required rate of return. As the required rate of return goes up, right, the value of the portfolio will go down. Okay. So you're exposed to this interest rate risk. So how can you manage this risk? You can enter into a forward contract with another party. So let's say that party is Rock Solid Insurance Company. Okay. So this other party agrees to buy the bonds for £5 million. Okay, at some point in time in future. Okay, so you enter into a forward contract with another party that agrees to buy your portfolio of T-bonds for £5 million. So First National Bank is hedged against interest rate increases in this case. Right? Okay. So what will happen if the interest rates actually decrease? The value of the portfolio will go up, right? Okay. So if interest rates do actually decrease, your value, the value of your portfolio would have increased, right? Okay. So you're basically hedging the downside risk, okay, by selling your portfolio in advance. So Rock Solid, on the other hand, has protected itself against interest rate decreases. So if, for example, the other party, which in this example is Rock Solid Insurance Company, if they expect interest rates to decrease, right? Which would mean that the price of these assets or price of this portfolio or the value of the portfolio will go up, right? Okay. So they are insuring themselves against interest rate decreases. Okay, so they're pre-committing to buy at £5 million and trying to eliminate this risk that interest rates might potentially go down in that period. Okay, so they might not have to pay more, right? Because if interest rates do go down, the value of the portfolio will go up, right? So if they don't enter into a forward contract, they might have to pay more. Okay, so one party is hedging against interest rate increases and the other party is hedging their risk where they expect interest rates to decrease, right? Okay, good. So both parties can gain or lose in such a forward contract. Okay, since we don't know which way interest rates will actually go in a year's time. But both are better off, right? Because one party is minimizing the risk of increase in portfolio price, and the other party is trying to minimize the risk uh, in case that the value of the portfolio goes down with interest rate increases. Okay? So both parties, so entering into forward contract gives some sort of certainty to both parties, right? They have pre-decided what will be the what it will cost them to buy this portfolio of bonds. Okay, good. Any questions here? Yeah.
In the previous example, this example, uh, is it like normal to hedge 100% of your position, or you leave a small gap to make a small profit?
Okay, it's completely up to the portfolio manager, right? The question is, do you hedge 100% of your asset? If your asset is a portfolio, right? Okay. Do you hedge 100% of it, or do you hedge 50% of it, or like 70% of it, right? It's completely up to the portfolio manager and their assessment of what they expect to happen in the market, right? If, for example, you're like 100% sure that the market's good, that interest rate, for example, would go up, right? Okay, then you would try to and if you own that portfolio of key bonds, you would try to make sure that you get the maximum value, right? So you might want to uh, get some sort of enter into a contract up to the 100% value of the value of your portfolio, right? So, but it varies. It depends on what the fund manager's expectation is about the market.
In this case, both the parties have different expectations of the market, right? But isn't there like a general market expectation? So, if one party agrees to sell it for X amount,
yeah,
if there's a general market expectation in favor of party A,
yeah,
why would party B want to buy it?
Okay, so this is a good question, right? So the question basically is, that so in this case, the two parties have very different expectations about where the interest rates will go. One party expects interest rates to go up, the other party expects interest rates to go down, right? And that's why they're entering into a transaction. And our question is there a general idea, right, in the market, what is likely to happen in the economy, right? Where the interest rates are likely to go, right? But if that is true, if everybody has similar valuations or similar expectations, then there shouldn't be any transaction at all, right? The reason transactions do take place is because different parties put different value of the asset, right? So if everybody, for example, knows the value of this chair is like 50 pounds, right? If everybody knows, right? If everybody agrees on this price, okay, then this share can't be sold at any other price. Okay. The reason the transaction will take place is because different people will put different value on the asset based on their use or potential use, right? Okay. And that's how transactions take place. So there are differences of opinion. There are differences uh, in expectations. Okay, and that is why the transactions do take place. Okay, of course it's uncertain, right? Because we don't know, right, where interest rates will actually go. So there might be, some sense in the market that interest rates, let's say, are likely to increase, for example, right? But even in that case, there might be differences in terms of how much the interest rates will go up. Okay. And again, so that differences in expectation will result in differences in price or value of the portfolio. Okay, good. Right. Okay. So here we have seen that, by entering into a forward contract, both parties tend to reduce their interest rate risk. One party hedges against interest rate increases, the other party hedges against interest rate decreases, right? But remember in this case, the gains of one party will be equal to the losses of the other party, right? Okay. So in such contracts, one party will end up winning, the other party will end up losing. Right, okay. So we can apply these forward contracts to hedge against our exposure to exchange rate risk as well, right? Because exchange rates do fluctuate over time as well, right? So you can use these forward contracts to hedge against your exposure to foreign exchange risk. So what is foreign exchange risk? The fact that exchange rate will change over time, right? Okay, good. So let's look at an example of hedging using these forward contracts uh, in the context of foreign exchange risk. So here we have a British exporter. So a British exporter has a contract with a US-based importer to deliver 100 million worth of goods and receive payment in 6 months' time. Okay, so what is the sales revenue for UK exporter? He expects to make sales worth 100 million pounds. Okay, and the cost of goods for UK importer translates into $144 million, assuming that assuming the exchange rate is $1.44 per pound. Okay. So the US importer expects to pay this amount, these number of dollars, $144 million for the goods that the US importer imports from the UK exporter. Right? Yep.
The line that says the spot rate is $0.44. the exporter pays $141 million in 6 months' time, isn't it supposed to be the importer?
Isn't it supposed to be the importer?
Pays
U.S. importer will pay
the
this.
the $9 billion.
Yes.
Yeah.
The exporter.
Pays
Oh, right. So there's a typo. That's what you're saying, right? The importer pays US $144 million in 6 months' time. Yes, that's right. Okay, so it's important. Good. Thank you for pointing this out. All right. So the importer expects to pay $144 million. Okay. What will be the interest? What will be the exchange rate in 6 months' time? Can you tell? No, right? We don't know. So in 6 months' time, if the exchange rate is actually $1.44 per pound, right? Then the UK firm receives 100 billion what it expects to receive, right? Okay. However, if the exchange rate is anything other than this exchange rate, if the exchange rate is anything other than $1.44 per pound, then there's a problem, right? Then the translated value, converted value of those dollars into pounds might be less or more, depending upon where in which direction exchange rate moves, right? Okay. So if the exchange rate in 6 months' time is 1.46 per pound, what does this mean? Has the exchange rate appreciated or depreciated? So let's say, has the pound appreciated or depreciated in this case? Pound has appreciated, right? Okay, in this case, now 1 pound is worth $1.46. Okay, previously it was 1.44. So now 1 pound is worth more dollars. Okay, good. So if pound has appreciated, it must mean that dollar has depreciated against the pound. Okay, so if the exchange rate in 6 months' time is $1.46 per pound, then what will happen? So the dollar revenue to the UK firm will be less than 100 million, which was the target, right? 100 million pounds. Okay, so in this case, what do we have? So let's say we have these three possible outcomes. So this is the original scenario where we have where the exchange rate is 1.44, right? Okay, in this case, when you translate it into pounds terms, it exactly, how much of this will will be worth 100 million, right? Given the exchange rate. Okay, so $144 million equates to 100 million pounds in this example, right? So there is neither a gain or nor a loss in this scenario, right? But if so, in the other two scenarios, what we have done is we have changed the exchange rate. In one case, the exchange rate, the pound appreciates. In the other case, the pound depreciates, right? Okay, if the exchange rate is $1.46 per pound, right? So how many dollars do we need to get 100 million pounds? We would need $146 million, right? Okay, so now we need two, two, 2 million more dollars to get to our revenue of 100 million pounds. Okay, but if, for example, the exporter has agreed to pay, $144 million, right? So we would have a loss in dollar terms of 2 million in this case, right? Okay, and if the exchange rate is $1.42 per pound, then we would end up having additional $2 million, right? Because if this is the exchange rate, right, then to convert these dollars into 100 million pounds, we would only need $142 million, right? But the exporter is paying us 144 million, so we'll gain $2 million, right? Okay. So you can see, depending upon where the exchange rate moves, we would either make a gain or we would make a loss. Okay. So, and this you can see we are exposed to this exchange rate risk, right? We are exposed to exchange rate risk. So how can we hedge that? How can we reduce this uncertainty? How much we will end up with, right? Okay, this is a target, right? We want to achieve sales revenue of 100 million, right? Okay, and we want to reduce or manage this uh, exchange rate risk. Okay, so to achieve 100 million target, now the UK firm needs an additional 2 million. Okay, right. If the US dollar appreciates against the sterling, and in 6 months' time, the spot rate actually is 1.42, okay, per pound, then we will end up making this additional 2 million pounds worth of revenue or profit. Okay, in this case profit, because we are converting those dollars into pounds. Okay, so this is how the payoff would look like, right? So conditional on where exchange rate moves, in which direction exchange rate moves, we will either end up making some money or will either end up losing some money, right? Okay, so here in this example, if the US dollar depreciates, right, which means pound appreciates, right, which you guys told me, right? So if the US dollar depreciates, exchange rate moves from, let's say, 1.44 to $1.46 per pound, then you can see, right, we will end up making a loss of $2 million. Okay, and contrary is true as well. If the US dollar appreciates, right, then we only need $1.42 million to $1.42 million would be what equal to 100 million pounds, right? But the exporter is paying us 1.44, right? So we end up making a gain of $2 million, right? So that's the payoff diagram from a UK exporter perspective. All right. Okay. Good. So if you are a manager in this firm, right? Okay. Let's say if you do nothing, right? If you do nothing and US dollar depreciates, you would end up making losses, right? Okay, so as a manager, you want to minimize or reduce this exposure, reduce this risk of foreign exchange conversion. So the exchange rate risk is beyond the control or influence of the individual firm, right? And provides the firm the chance of either gaining, right, or the possibility of losing, as we have seen in the payoff diagram. So how can the firm avoid or mitigate this exchange rate risk, right? We can use forward contracts to address or minimize our exposure to exchange rate risk, right? So what we can do is we can enter into a forward contract to exchange $144 million that we expect to receive in 6 months' time, right? So we know we have sold goods to a US importer, and US importer will be paying $144 million in 6 months' time, right? So we expect to receive $144 million in 6 months' time. Okay, so we can enter into a forward contract. Okay, and that forward contract time would be 6 months because that's when we will have these $144 million. Okay, so enter into a forward contract to exchange the amount of dollars that you expect to receive in 6 months to convert those into in pounds terms at a forward exchange rate. That forward exchange rate will be determined at the time when you enter into a forward contract. Okay, so you can lock the exchange rate today, and that will give you certainty in terms of how much of those $144 million would be worth in pounds terms, right? Because you have locked the exchange rate by entering into a forward contract. Okay, so enter into a forward contract. Let's say the other party is Royal Bank of Scotland, RBS, right? So you enter into a forward contract with RBS today to exchange those 144 million that you will receive in 6 months' time at a forward exchange rate of $1.44 per pound. Okay, so you don't really have to enter into a forward contract with a bank, right? It could be any other party who is willing to buy dollars from you uh, uh, in exchange for pounds, right? It could be any party. It could be two firms as well. So let's say there is a UK exporter in this example who sells goods to US. There might also be another firm who imports goods from US, right? So they can, enter into an exchange contract within themselves as well. So it doesn't really have to be a bank. It could be any other party that is willing to accept or buy dollars in exchange for pounds. So how the transaction will take place in this case, UK firm receives 144 million in 6 months' time. So it will give those 144 million to RBS, and in exchange, RBS will give 100 million pounds to the UK firm because this exchange rate is locked in when you entered into a forward contract. Okay, so UK firm ensures by entering into a forward contract that they will receive 100 million pounds. Okay, good. All right. Okay, so UK PLC has effectively locked in an exchange rate of 144 pound, $144, $1.44 per pound. All right. So this guarantees that the firm will receive 100 million pounds, irrespective of what happens to the exchange rate. Okay. So in the previous diagram, we have seen that if the exchange rate, okay, let me just take you back to this diagram, right? Okay, if the exchange rate moves in a way the US dollar appreciates, right? So UK PLC would have gained something, right? So by entering into a forward contract, it's also, you can see, foregoing this potential of making some money. Okay. Okay. So not only is hedging itself against the downside risk, but it's also foregoing the opportunity to make some money if the exchange rate go in a direction that would increase the value in pounds terms. Good. Any questions here?
Is it common for firms to enter into contracts with each other, or is it only done with financial institutions rather than a forward contract?
Okay, so these financial institutions have an advantage, right? They have this information advantage because they deal with a lot of a lot of firms, a lot of customers, right? Uh, so, so you know, it's much more convenient because if they are kind of specialized into doing something like this, then it's much more convenient for a firm to go to a bank, right? But financially, it might be, uh, it varies. It depends upon the situation, right? So as I mentioned, you don't really have to go to a financial institution to enter into such a contract, right? You can, do it with another counterparty, and there might be some incentives for you to do it within the firms as well, because if you go to a third party and an intermediary, they'll charge you for something. They'll charge you some sort of commission or transaction fees, right? So, but the advantage is, they know this stuff. They do it um, uh, quite frequently. So, so the efficiency, they're much more efficient in carrying out the transaction. Okay, so so you can write the payoff of any forward contract in the following fashion, in the following form. So payoff from a long position in a forward contract on one unit of an asset is these is the price at time t, price at maturity, right? Minus K, which is the contract price, right? Delivery price of the forward contract. Okay. So if K is the delivery price of a forward contract and ST is the spot price of the asset at maturity. Okay. So the payoff of a long position in such a contract would be ST minus K. If ST is greater than K, right?
Yeah.
What?
Until the payoff is done.
Okay. Okay, so you can write the payoff in the following form. Okay, so but if, for example, you are writing this forward contract, right? If you're selling this forward contract, say, for example, you're a bank, right? And you're in, and you are taking a short position, right? By selling, it means you're taking a short position in the contract, right? If you're selling the contract or taking a short position on the contract, your payoff will be the opposite, because you will pay the forward price we just carried, and your payoff will be the difference between the price that you pay and the current market price at maturity. Okay. So the payoff, as we have seen, can be positive or negative depending upon in which direction the exchange rate moves. Okay. Anything that you want to ask here? Any questions? No. Okay. All right. Good. So I I think the key takeaway for this is the payoff of one party in this case will be exactly equal to the, let's say, instead of saying payoff, the gain of one party in this case will be exactly equal to the loss of the other party, because both of these terms at maturity are fixed, right? So the gain of one party will be exactly equal to the loss of the other party. So, for example, the long position holder is making a gain, right? Short position holder will be incurring a loss of exactly the same magnitude. So here what I've done is I've summarized it, right? So we have seen the risk to the business if the exchange rate is not predetermined, if the firm doesn't enter into a forward contract, right? So we have seen, uh, if the dollar depreciates or pound appreciates, right, the firm will have a loss of 2 million, and in the other case, there will be a gain of 2 million, right? But if, for example, the firm enters into a forward contract, right? Okay. So in the baseline scenario, there is neither a gain nor a loss. So the forward contract payoff is exactly the same, right? As in the case where you have not entered into a forward contract. But in the other two cases, right? So in this example, in this scenario where the exchange rate is $1.46 per pound, right? Okay. So in this case, the payoff from UK firm long position in a forward contract will be positive 2 million, right? But because you have agreed, you have entered into a forward contract at a price at an exchange rate of 1.44, so you'll forego this, and uh, the your payoff in this case, you will not gain this 2 million in this case, right? Because you have locked in the price at 1.44, and the same is in the case of the opposite scenario where you make a loss of 2 million, right? But because you entered into a forward contract, your net effect is zero, right? So the loss that you make here in this scenario is offset by the gain in a forward contract. Yeah.
So does the UK fund like today enter two different contracts, one with the American importer and one with the bank?
No, with an American importer, it's not a contract, right? It's a sale that you made,
Okay, it's a fixed price of
and they'll give you $144 million. So your exposure is how much of that $144 million is in pounds terms, right? So you want some sort of certainty, right? So you lock in an exchange rate to make sure how much of $144 million that you will receive in 6 months' time are worth in pound terms. Okay, and your gain or loss, because if you enter into a forward contract, you have locked in the rate, right? You're certain, right? Okay. So there will be no gain or loss, right? The gain or loss will depend upon what the actual exchange rate is in 6 months' time. Okay. So the idea basically is, if you're in this scenario, here you have a loss of $2 million, right? But if you enter into a forward contract, the forward contract generates a gain of $2 million, and the two cancel out. So your net effect is zero. In this scenario, you gain $2 million simply because the exchange rate moved in this direction, in this fashion, right? But because again you enter into forward contract, your forward contract will have a payoff or loss of $2 million, right? So the two again will cancel out, and you'll end up with the net gain or loss of zero, right? So this is how the payoff would look like, okay, depending upon where, in which direction exchange rates move. Right, okay. So this is the payoff of a forward contract, right? So in the previous example, I showed you the payoff when we didn't enter into a forward contract, right? And you can see the direction of the two are opposite, right? The first one was downward sloping, right, like this. Okay, and this one is upward sloping. Okay, So which basically means the gain in one scenario is offset by the loss in the other. Okay, so another so here we have another type of a forward contract. We call it non-deliverable forwards, right? So in a non-deliverable forward contract, there is no physical delivery of the two currencies. Okay, so in the previous example, we have seen that the UK firm will receive $144 million. It will give that $144 million to the party, right? And the other party will give $100 million to the UK firm. So in a non-deliverable forward contract, there isn't any physical exchange of the underlying asset. If we talk about the currencies, so there wouldn't be any exchange of currencies in this kind of forward contract. So contract is settled by a net cash payment in a fully convertible currency. So convertible currency is a currency that has an active market, right? And you can trade, exchange that currency without any loss in value. So it's an actively traded currency. So the amount of cash settlement and who will pay that, right, will depend upon the actual spot rate on the expiry date. Okay, and the transaction is based on the differential, right? Any differential between the agreed forward rate and the actual spot rate on the expiry date will determine how much cash will be paid and by which party. So the exposure to a non-fully convertible currency versus a settlement versus a scenario where the settlement will take place in a convertible currency. So one key advantage of such non-deliverable forwards is if you're dealing with a currency, right, that's not fully convertible, right, that does not have an active market, that's basically used for domestic transactions. Okay, so by entering into a non-deliverable forward contract, you can get the cash payment in a convertible currency rather than non-fully convertible currency. So you avoid the risk of acquiring a non-fully convertible currency. Okay, so let's take and let's look at an example. So here we have an exporter. So UK PLC is due to receive check corona amounting to 543 million in 3 months' time for goods. In 3 months' time for goods equivalent to 10 million pounds. Okay. So the outright forward market in this currency is likely to be very illiquid and not favorable to the UK PLC, right? So the UK PLC would want to avoid receiving 543 million Czech coronas, right? So what will the UK exporter do in this case? So here we create these three different scenarios, three possible outcomes, right? So if you look at the example again, so the company expects to receive 543 million coronas, right? If the exchange rate is actually 54.3, that would translate into 100 million pounds, right? So we have different scenarios, just like the previous example. right? Just like the previous example. So in one scenario, we have a depreciation, and in the other scenario, we have an appreciation, and then we have a base scenario in the middle. Okay, so if the spot rate in 3 months' time is actually 54.3, that translates exactly equal to 100 million pounds. Okay, but if we have a depreciation of Czech koruna, right? So, and if the exchange rate is 56 instead of 54.3, right? Our equivalent amount in pounds term is less than 10 million. Okay, and if we have an appreciation here, if Czech koruna appreciates to 52.6, right? Then we end up, then in pounds terms, we end up making some money, right? Because these will translate into an amount which is greater than 10 million pounds, right? Okay, good. So if you enter into a non-deliverable forward contract, let's say with a bank, right? Okay, and the forward rate, this non-deliverable forward rate that you've determined, let's say that's 54.3. Okay, so you enter into a non-deliverable forward contract with another party at a forward rate of 54.3, right? Okay, so in this, if the forward rate is exactly equal to the spot rate, right, we get 10 million, so no payment is required, right? But if our forward rate is less than the actual spot rate, right, then we have a loss of 300,000. No, how much is it? 300,000. 300, no, 300,000, 303,571, right? Okay, so in this case, in pounds terms, we will have a loss, right? So by entering into a non-deliverable forward contract, right, the bank will compensate us for this difference only, right? Not the actual amounts. Okay, so only the difference. So this is the loss, 10 million minus this amount, we get this figure, right? So the bank will pay this amount to the UK PLC, so they'll end up with 10 million. Okay, but if we have the opposite scenario, if the actual conversion, if the spot rate is 52.6, right, and our forward rate that we specify in the contract is 54.6, right? So in this case, in pounds terms, we get more than 10 million, right? But because we entered into a forward contract, in this case, any additional that we generate, we will have to pay that to the bank. Okay, so the bank will, so this gain that we generated, the difference between this and the 10 million, right, we pay it to the bank. So in this case, UK PLC will pay 323,194 to the bank. Okay, and each scenario, as a result, you end up receiving 10 million pounds. All right, so in a non-deliverable forward contract, only the differences are being paid by the counterparties, okay, rather than the actual delivery or exchange of actual amounts received. Right, okay. Okay, so before we look at forwards, let's have a quick 5 minutes break, okay? And then we'll look at another type of derivative securities.